want to make sure that's not there. That's why it's important. You guys have a good weekend? Okay, well, we are going to start. There's 27 of you here, so we're getting there. So I just want to point out to the people that are on Zoom, I don't have a moderator here, so do not chat anything to me. So if you have questions, then you just want to put your hand up, or you can turn your microphone on, right? So nobody is is looking at the chats today. Okay. Okay, so we are going to start something new today. You guys sick of accounting yet? Or did you have a nice restful weekend and all rejuvenated, right? Excited? So hopefully you're happy with your grade and you're excited and you're moving on and learning good things. So today we are going to start, it's just a little topic focus 3. So if you read the chapter and it's okay, or it's not even a chapter, it's really just a series of pages. So if you are keeping up with in the textbook, after chapter 4 is that topic focus 2 that we are skipping, right? So that's the process costing that I said was simple. So we're not worried about that. Topic focus 3 is what we're covering today and tomorrow. And what we're looking at here is a new management system. So we are going to be looking at a system that managers would run in order to get a clearer picture of how well they are performing. All right, so if you've read these few pages, what they talk about is variable costing and absorption costing. Well, the good news for you is that absorption costing, you already know. That's job order costing, that's GAAP, that's the accounting that we just learned in chapter 4. So absorption costing is required by GAAP. It uses your traditional income statement, right? Your sales minus cost of goods sold, because you know that's what GAAP uses, right? Product costing approach includes both variable and fixed costs. So what we know about GAAP is that inventory is valued at the cost of making it, and it includes every single cost in your factory, which is direct material, direct labor, and manufacturing overhead, right? No distinction between these two. Every cost in your factory is tied to inventory. All right, so this is what we know. This is what we did in chapter 4. Now what I'm going to show you is a management system that's called variable costing. Variable costing is not GAAP. Product costing or inventory is only going to include your 3 variable production costs. So under this new management system, we are going to value inventory only with direct material, direct labor, and variable overhead, our 3 variable product costs. Fixed factory overhead is no longer going to be considered inventory. We are now going to call it a period cost. Okay. And as you can see, this is only for internal management purposes. You cannot prepare an income statement and put it out to the public with inventory not including fixed factory overhead, right? Everybody understands GAAP includes every cost in the factory. This new management system, not following GAAP, but I'm going to show you why managers like it and how it is helpful to them. So under absorption costing or your accounting system that every company has, both revenue and inventory fluctuations are going to cause a change in your net income. And this gets confusing for managers because they're trying to see how well they are performing. Remember when we did cost volume profit analysis, you're constantly trying to make improvements and changes. And then you're constantly looking at that net income to see which change gave you the higher result, right? So what I'm going to show you now is in accounting systems, there's 2 things that are causing your net income to change. Yes, your volume, all of what you're doing for advertising and changing packaging, that's going to cause improvements or increases in volume of revenue. But you also are going to see that your inventory levels, as they fluctuate, are going to cause a difference in net income as well. And that gets really confusing because I'm trying to figure out, did my idea work? Did it not work? I can't tell because the inventory is all in there as well. So what we're going to do is I'm going to introduce you to this new variable costing system. And there's only one thing that is going to affect your bottom line, and that is your revenue changes. And so it's so much easier for you to see how well you're performing in terms of what you're doing to make improvements because it removes that inventory distortion. Oh, and I should say the other big benefit to that variable costing system is that it's in contribution format as well, right? So you know as soon as you have that contribution format, that's a huge tool for you to continue to play around and try to make improvements. All right, so just a reminder here, absorption costing, this is what we know. Product costs or inventory are direct materials, direct labor, and all of your overhead. Every cost in the factory is getting tied to inventory. Outside of the factory, we are calling anything outside of the factory period costs, selling, administrative, operating expenses. Under this new variable costing system, what I'm showing you is the only difference is fixed factory overhead is no longer going to be a product cost. Only your variable production costs are included in inventory. Fixed factory overhead, now a period cost. And remember, period costs are still always period costs, right? It's just fixed factory overhead that we are now including as a period cost as well. All right, so this is going to remind you then, or require you to remember, why do we care about product or period? Because we expense them differently, right? Your inventory or your product costs go into work in process inventory, direct material, direct labor, variable overhead. Oh, yes, under chapter 4, and then it'll say topic focus 3 or variable costing. Okay, so in your accounting system, remember your product costs are all recorded in the work in process inventory, right? Raw materials, direct labor, or direct materials, direct labor, and all of your overhead are all tied to inventory. And then they go to finished goods when they're completed, and there they sit until you sell it, and then you're going to match the cost to the revenue. So now with this variable costing system, fixed factory overhead no longer going to the balance sheet. Your fixed factory overhead is going directly to the income statement. This will all get expensed in the period as incurred. It is no longer going to be matched to that revenue. All right, so I'm going to run through this data 3 times. And you might want to take a picture of it if you don't have your slides up, because we're going to be using this data here. So this is Jersey Fabrics. So they sell the jerseys to CNC Sports that make the jerseys. So here I have it per unit. It was per yard in your textbook, but I figured I'd make it easier for you to kind of think about. Right, so you are selling at $7 per unit. The direct material that goes into each unit is $1.26. Direct labor is 54 cents. Variable overhead is 30 cents per unit, and variable selling is 12 cents per unit. These are all your variable costs. We know variable cost per unit is constant, right? Every time I sell a unit, I'm going to incur these costs, same costs. Here's all of your fixed costs. You have $6 million in fixed factory overhead, and you have $5.8 million in fixed selling and administrative expenses. Okay, so what we're going to do is we are going to be preparing income statements 3 times. So the first time I'm going to produce 4 million units, and then I'm going to sell the same 4 million units. So there's no inventory fluctuation. There will be no distortion. So we are going to get the exact same net income, but by doing this income statement, I'll at least be able to show you where the problem is, and then we'll move into fluctuating this inventory. Okay, so I'm making 4 million units, and I'm going to sell them all. Right, so the first thing, if you're going to be able to calculate income statements, you have to be able to tell me, what is it costing me to make a unit of product? And it's going to be different under absorption costing and variable costing, because under variable costing, I only include direct material, direct labor, and variable overhead, right? I only include my variable production costs. Under GAAP or under absorption costing, I need to include this, right? The 6 million. All right, fixed costs. Let's say this is the rent of your factory, fixed factory overhead. How can I get this on a per unit basis? How do I get fixed overhead like when I made my tables? How did I take my rent and allocate that indirect cost, Claudia?
You divide by the units that were produced.
Units produced, right? Units produced here, not units sold. Remember, these numbers are the same right now, but they won't be in the next example. You're trying to figure out, what does it cost me to make my product? And so if this is what you spent in rent, you would have to spread it out over the 4 million units that you produced to figure out what it cost you to make that unit. Okay, so I'm taking that 6 million, I'm going to divide it by the 4 million units produced. And what you're going to see is under GAAP or under absorption costing, you've got an extra $1.50 in fixed factory overhead tied to each one of your units. Variable costing, just your variable production costs. Absorption costing has to have every cost in your factory with an additional $1.50 per unit. Is everybody good here? Okay, so let's prepare the income statements. So you should know, if I ask you with this data given to you, prepare the income statement under absorption costing or prepare the income statement under variable costing, which almost always I've seen questions like that on your, hate to talk about the next exam, but might as well start, right? So if I ask you what's the contribution margin, you know you are using variable costing, right? That is the contribution format. If I ask you gross margin or gross profit, you know you're using your traditional accounting system. So it matters because your inventory is valued differently here. Okay, so let me just show you how you would do your absorption costing income statement. So remember, we are selling 4 million units, right? So we would, and I told you the selling price was $7 per unit. So the 7 times 4 million units sold is telling you the revenue that you have. You know your first expense under absorption costing is cost of goods sold. What I have here is cost of goods sold broken down so I can highlight what's causing the problem, that fixed factory overhead, right? But how do we get the direct material, direct labor, and variable overhead? Think about the matching principle. This is what's happening, right? In your accounting system, you're saying, I sold a unit for 7. What did I have to spend to make that unit in order to get that 7? So this makes total sense. I put $1.26 in materials into each one of those units that I sold for $7. So I'm matching the cost to the unit that I sold. Same thing for direct labor. Matching principle makes sense. I paid somebody 54 cents to make the unit that I sold for $7, matching the cost to that revenue of that unit. Variable overhead, again, if I had to run my utility bills, right? If I had to run the machines a certain amount of time to make that unit and I spent 30 cents in utility, then it makes sense to match that cost to that revenue. Fixed factory overhead, we're doing the same thing. We're taking that fixed factory overhead, that cost per unit, multiplying it by the 4 million units sold, and we're matching cost to revenue. But is that the way the rent works? No. Do I pay rent $1.50 every time I sell a unit? No. The rent is the rent. They don't care whether I'm selling anything or making anything in that factory, right? So this is where the problem is. This is not really an item that should be matched to revenue. The rent, that 6 million is happening regardless of whether you sell anything. And so under your variable costing, we're going to call it a period cost. And regardless of what we sell, 6 million in rent, if we paid it, is going to be expensed in that period. And you can see here, because there's no inventory fluctuation, we're getting the exact same net income here. Units produced are the same as units sold, and there's no inventory fluctuation. But let me also show you, actually, any questions on this first? Does this all make sense?
Okay. Professor?
Yeah.
Could you please go over again the last thing you mentioned about fixed manufacturing overhead?
Yep, so fixed factory overhead. So the whole problem with accounting is the matching principle here. Because the matching principle, you know, cost of goods sold is saying, when I sell and I have the revenue on my books, that's when I match the cost of making that unit to that revenue. And material, labor, and variable overhead all make sense because you have to incur these costs for each unit that you are selling. The problem is that fixed factory overhead doesn't work that way. I don't pay $1.50 in rent every time I sell a unit. I pay $6 million in rent. The way we got the $1.50 is that we spread that rent out over the 4 million units that we produced. It doesn't happen with each unit. So the matching principle isn't quite right here. So instead of putting it here, I'm just going to say it's a period cost, not tied to the revenue. So in my variable costing system, all 6 million will be expensed every period. Does that make sense?
Yeah, thanks.
Okay. And just to kind of put this back into what we talked about, right? So think about how this works. I have those 4 million units that I produced this period. That $1.50 is in each one of these, right? I took the 6 million, I spread it out over these 4 million units, and each one has $1.50 in fixed factory overhead tied to them. If you're selling them all, then all of that $1.50 tied to these units are heading off to the income statement. So you're going to see all $6 million tied to these units expensed in that period because they're sold, matched to revenue. I don't have anything left. Okay. But that's not going to be the case if I don't sell everything. Right? So let's take a look at period 2 now. Right, so now in year 2, we are going to have some inventory fluctuations. So our net income is not going to be the same. I'm going to make the same 4 million units, but this time I'm going to sell only 3.75 million of them. So that means I'm going to have 250,000 units that are not sold and have to remain on the balance sheet. Right, so when I am going to be calculating my income statement here, what you're going to see is that your net income is going to be higher under your accounting system. It's going to be misstated because your $6 million in rent will not all get expensed in this period. It's all going to be tied to these 4 million units, but if they're not all getting sold, then they're not all heading to the income statement. The $1.50 that are tied to these units that are going to remain in finished goods, we call that deferring fixed factory overhead. Eventually it'll get there, but this period it's not getting there. And now I've done it again. You can see your net income is not the same. Net income is higher under absorption costing when you produce more than what you sell. And so I'm showing you the problem with the matching principle here. We know that we have $1.50 that is allocated to each one of those 4 million units, right? When I made it, when I produced those units, I allocated the $1.50 to each one of these 4 million units. But when I'm looking at what went to the income statement, I'm matching all of this to what I sold. If I only sold 3.75 million, then I'm only matching $1.50 to those same units sold. Right? Cost of goods sold is matching what it cost me to make the same units that I sold. So I'm seeing not all of my rent hitting the income statement in this period. It's misstating my income statement. It's making it look like my net income is higher than what it actually is. And you can see with this variable management system, you don't get that distortion. They're saying, I know that this isn't tied to the units that I'm selling. It's not matched that way. So I'm calling it a period cost, and I am just expensing it all in the same period. Did I pay the rent? Yes. So I'm going to expense it. Did I pay the rent in my accounting system? Yes. But do I have to show it all in my income statement? And the answer is no, because some of that fixed factory overhead is tied to units that weren't sold. And this might help you to take a look at what's happening here. So in period 2, remember we had sold everything last period, so we started with nothing. We made another 4 million units, but we only sold 3.75 million of them. So I have 250,000 units that weren't sold, right? So all of that 6 million was put into these 4 million units. But where is it at the end of the period? Right, so you can see $1.50 tied to these units here, these 250 units. That means $375,000 of that 6 million went nowhere. It had to stay on the balance sheet because it's tied to units that weren't sold. The rest of it, you can see, went to the units that were sold, the 5,962,500. Under variable costing, all 6 million is expense, but under absorption costing, you're seeing of the 6 million that was put in here, $375,000 of it stays on the balance sheet. It's a product cost and it's tied to inventory that wasn't sold, so it cannot be matched to revenue. Okay, makes sense? All right, so down here, what I'm showing you is the little cheat that they give you in the textbook, and they tell you, and what you're going to have to do is once you've calculated one net income, tell me what the net income is going to be under, like if you calculate absorption, what will the net income be under variable costing without doing the income statement? And so this little cheat is telling you how to tell you what the difference in net income is going to be. So it's what we just said, right? The difference here is going to be $375,000 because this is the difference in expenses that were not pulled to the income statement that were under variable costing, right? So the textbook tells you, look at the change in your inventory. If you went from nothing to 250,000 units at the end of the period, that means you must have produced more than what you sold, right? If your inventory goes up, then you are producing more than what you're selling. And that means that you're going to have ending inventory and you're going to have fixed factory overhead getting deferred. It will be tied to those units, not heading to the income statement. Less expense on your income statement means higher net income. Okay. All right, so this works for this problem, but then I'll show you why I don't like it. All right, everybody's good? Okay, nobody made a note of what I just said there, right? Did I just say that producing more inventory will cause your financial statements to increase in net income? And the answer is yes, right? So they call this the hat trick. This is another way of being able to manipulate your financial statements. If at the end of the period and you are looking at a net income that isn't quite where you want it to be, you can produce a little bit more inventory. And you know, in your accounting system, what that's going to do is it's going to take some of the inventory, that rent, tie it to those extra units that you know you're not going to be selling, and you are able to defer the rent. So you are intentionally making more than what you are planning on selling so that you don't have to expense all of the rent in this period, right? It's not like estimates where you don't have to go back and fix anything. This is a temporary fix, so you have to be more careful with this because eventually you do have to sell those units. And when you sell them, that's when they get released to the income statement, right? So if you need a little boost right now, you can make a little bit more inventory and it will help. But just remember, when you sell them, that's when you're going to see those costs getting released. So you better be able to handle those costs next period. All right, so what I'm going to show you now is year 3, when I do have to sell those units, right? So in year 3, I'm going to make another 4 million units, but now I'm going to sell 4.2 million. So I'm going to sell everything I made this period, plus some of those units that I was not able to sell last period. Okay. Under your accounting system, now you're going to have the lower net income because what you're looking at, again, that matching principle is saying $1.50 times the units sold. right? How much rent did you pay this year? $6 million. But how much rent are you showing here? $6.3 million. What you deferred from year 2, when you sell it, you're going to see it released. Now you have more fixed factory overhead hitting the income statement in this period, which is going to bring your net income down. Does it make sense? And we can put it into that T account so I can show you what's happening here, right? So these were the 250 units that we didn't sell from year 2. Remember, it was the 375,000 in fixed overhead that got deferred, causing my net income to be overstated in my accounting system. Right? Is everybody good with that? Right. Then I make another 4 million. So now I have to figure out what I'm selling. Right. So I'm looking here and I'm going to sell not all of it, right? Of the 4.25 million units, 2.4 are sold, which means 50,000 units are not sold. Right. So what I'm looking at here is, and this is how they tell you how to do this, look at your change in inventory. Right. So my inventory went from 250 units to 50,000 units. Inventory goes down from 250 to 50, which means you must be selling more than what you are producing, which means you're going to have a higher net income under variable costing. Right, so I look at the change in inventory, which is 200,000 units decrease, multiply it by the fixed factory overhead, and the difference in net income is going to be $300,000. Net income is going to be $300,000 higher now under variable costing because I'm only expensing $6 million, where here you can see I need to expense $6.3 million matched to these units sold. Is this making sense? So this is just reminding you, this is going to be fine if you understand the matching principle and product and period. Right, so what I want to show you now is why I don't like this little cheat that they give you in the textbook. Because this only works if the fixed factory overhead is the same in these units and the same in these units. And the only reason why there's $1.50 in all of these units is that we produce the same 4 million units all 3 periods, right? How did we get the $1.50? We took the 6 million and we spread it out over the units that we produced. And I'm telling you now, almost never do you see the exact same production from period to period. And so what you're going to see is your fixed cost on a per unit basis is going to fluctuate, right? If I'm spreading it out over 4 million, then I get $1.50. 5 million, then I'm going to see it go down, right? So in this case here, if I did have different levels of units produced, I would need to know whether I'm using LIFO or FIFO here, right? Because what am I selling? Am I selling the old stuff first, right? Because I look in here and I'm looking at 4.2 million. Did I sell all of these and then some of these? Or did I sell all of these first, right? My first in, first out, and which are the 50 units that I didn't sell part of this? Right, so in reality, you would need to know LIFO and FIFO because the fixed factory overhead that you're releasing from a different period could have a different cost. I'm going to say doubtful that you're going to see this if they're giving you this shortcut, but I do know there's a homework problem that you do have to do it, so you can come back to this. And then, of course, if you want to know how this works in real life, you're better off kind of skipping this and really kind of thinking about what units are being sold, what's getting released from which period. And that way you're never going to go wrong. Okay, so here is a little cheat sheet for you, a little summary. So if you produce and sell the same units, which is the first time we went through this, if we produce 4 million and sell 4 million, that means that there is no difference in net income. All of the fixed factory overhead tied to the units are sold and expensed under your absorption costing, and you know they're all expensed under variable costing because they're a period cost. No difference. When you sell more than what, and when you produce more than what you sell, then that means your net income is going to be higher under absorption costing. When you produce more than what you sell, your inventory is increasing, which means you're going to end up with more ending inventory. And in your accounting system, you're going to have fixed factory overhead tied to those units. And we call that deferring it from that period. Did you spend it? Yes, except the matching principle is saying, I don't have revenue to match it to, and so you're not expensing it. And then when you sell more than what you're producing, that means that you must be releasing the costs from a prior period. Anything that gets deferred eventually will be released when you sell those units. Okay. Make sense? Okay, so this problem is going to do 2 years. The first year, you're going to sell more than what you produce. No, you're going to produce more than what you sell, and then we'll sell more than what we produce. All right, so it says prepare the income statement using variable costing and absorption costing. They give you the data. They tell you prepare the absorption costing income statement for year 1, and then see if you can predict what the net income is going to be, and then prepare the income statement under variable costing and prove that it will be what you said it was going to be, right? Then we're going to do the same thing, preparing the income statement under absorption costing when we're selling more than what we're producing, predict what the net income is going to be. It should be higher under variable costing, and then prepare the variable costing income statement and see that the net income is what you predicted it to be. Okay, so let's take a look at the data. Hadlock Manufacturing manufactures a single product that it will sell for $68 per unit. The company is looking to project its operating income for its first 2 years of operations. Cost information for the single unit of its product is as follows. Okay, direct material, $30 per unit. Direct labor, $11 per unit. Variable overhead, $5 per unit. Variable operating expenses are $3 per unit. And then fixed manufacturing overhead is $176,000, while fixed operating expenses are $86,000. All right, so during the first year of operations, the company plans to manufacture 22,000 units and anticipates selling only 16,000 of these units. So we are going to produce more than what we are going to sell. So that means net income should be higher under which of these 2 income statements that we prepare. Claudia.
Absorption.
Absorption. Yeah. Absorption costing should give you the higher net income because you're going to have 6,000 units that aren't being sold, right? You're going to be applying or allocating all of the overhead to the 22, but you're only selling 16. All right, so before we do the income statement, the first thing we're going to have to do is figure out what is it costing us to make what we sell, right? We're going to have to do cost of goods sold. So you have to figure out what does it cost me to make 1 unit under absorption costing, and what does it cost to make 1 unit under variable costing. So we're doing absorption first. This is for everybody. Okay, I'm gonna close it out. Last chance. Okay. 26%. Did I share? Yep, 26% said 54. 55. 26% said 46. 15% said 16. Okay. All right, so if I'm asking absorption costing, that's what we know already, right? So I know that my inventory is valued with every cost in my factory, which is direct material, direct labor, variable overhead, and fixed factory overhead. So how do I get fixed factory overhead on a per unit basis? I need to divide that by the units that I produced, not sold. I'm trying to figure out under GAAP, what does it cost me to make instead of buy what I am selling? So under absorption costing, it's direct material, direct labor, variable overhead, and then you're adding an additional $8 of fixed factory overhead to that unit as well. Remember, period costs are never product costs, right? Just because it's variable, you don't want to add it to inventory. And then variable costing is direct material, direct labor, and variable overhead, just your variable production costs. All right, this is step number 1, because next we're going to be preparing our income statement under absorption costing. So as soon as I ask net income under absorption costing, I'm using my traditional format, right? Just like your accounting system always shows you. And I know my cost of goods sold is going to be $54 per unit. This is what it's costing me to make each one of the units I'm selling. Okay, so under absorption costing, the selling price they told us was $68, and they told us we were selling 16,000 units. So if I sold 16,000 units, now I need to match the cost of those same units that I just sold, right? Matching the cost of making the units that I sold. So here, I don't need to lump them all or put them all separate like I did before. I was just trying to highlight the fixed overhead issue. So here, I know that if I'm saying each one of those units cost me $54 to make, then it cost me $846,000 to make what I turned around and sold for $1,088,000. Sales minus cost of goods sold gives me gross margin or gross profit. And now I'm looking for those period costs. Again, they were given to you in terms of variable and fixed. I don't care about variable or fixed in my traditional income statement. I care about product and period. And so all of my period costs are deducted after gross margin or gross profit. Here's the fixed portion of the $86,000, and then the variable portion is that variable cost per unit given to you at $3 per unit. And remember, it's a selling expense. You are also multiplying that by units sold. So you get the total variable, add that to your total fixed, and you have your total period costs. Okay, so sales minus cost of goods sold gives you gross margin or gross profit, minus your period costs gives you net income. All right, so the next question is, now that you have that income statement, what's the net income going to be under the variable costing statement? Right, so before you calculate it, you should know how to answer that question. So what I'm going to say is it's going to be less than 90, right? Because I produced 22 and I only sold 16, which means when I'm looking at that 90, that's telling me that I have not expensed all of my fixed factory overhead costs. Some of them are tied to those 6,000 units that weren't sold. Right, so how much less is it going to be? If you want to follow the shortcut that they give you in the book, they tell you, look at the difference in your inventory, right? If you produced 16 and then sold, produced 22 and then sold 16, you're going to see your inventory go from 0 with an ending balance of 6,000 units. So you're going to have fixed factory overhead tied to those 6,000 units that weren't sold. So $48,000 of your fixed factory overhead is staying on the balance sheet and inventory. Right, so that's the difference in your net income. So take the 90, I know I'm subtracting it from that because I know this is higher under absorption and my net income under variable costing is 42,000. Ashley,
I just have a question. Where are we getting 42,000 from?
I took the $8 in fixed factory overhead and I multiplied it by the change in inventory. This was the shortcut way the chapter tells you to do.
That's 48,000, but what did we subtract to get to 42,000?
90. So
Oh.
what I'm saying is if you know one net income, you should be able to calculate the net income under variable. So I know this is going to be higher because I have produced more than what I've sold. When I look here, then I'm saying it's $48,000 higher. So I'm taking the 90 and subtracting 48, and I am predicting that my net income under variable costing is going to be 42, $48,000 less.
Thank you.
Right, so that's how they show you in the book. If it helps, you can think about it, the T accounts that we were using, right? You produced 22, you sold 16, you have those 6,000 units that weren't sold. So you have $8, you can see I wrote it up here, $8 of your fixed factory overhead is tied to these units that aren't sold. So 8 times 6,000 is 48,000 of that 176 that is not getting expensed in this period. They're telling you, look at the change. You went from 0 to 6, so your inventory increased, meaning you must have produced more than what you sold. Right, so you can use their shortcut. 0 to 6 means that I went up 6,000. Here I'm looking at these 6,000. Each one has an extra $8 tied to it, or $48,000. Okay, and then here's the variable costing income statement. And you can see that when you do it out, it does give you that net income of $42,000. So take a look at the contribution formatted income statement here, right? Under variable costing, we're always going to have a contribution format, same sales revenue, but now I'm going to deduct out all of my variable expenses. So here's your variable, or here is your cost of goods sold, which is always going to be variable under variable costing because that only includes your variable production costs. That 46 is just the direct material, direct labor, and variable overhead. And then here's your variable selling. Right, so all variable costs are deducted from sales to give you your contribution margin. And then take a look at that fixed factory overhead. It's a period cost. All 176,000 are going to be expensed in the period as incurred. And then here's your fixed operating, and you can see your net income is 48,000 less than what you calculated under absorption costing. I think I'm going to wait to do year 2. Year 2 is the trickier one. All right, so if you have not read this little topic focus, like I said, it's not even a whole chapter, it's just a few pages. Take a look at it. And it's just a few pages. So we're going to finish it up on Wednesday. So small amount of reading, but like I said, it's going to require you to think some and kind of go back and think about that matching principle and product and period. And then once you've got those topics down, it should make more sense to you. All right, so we'll finish this up and then we'll do more problems. I'll try to show you, give you different approaches to it. And then we should be good for Wednesday. And I'll hang if you have any questions on what I have done so far.
Thank you.
See you later.
Yeah. Was it feedback we did yesterday? Are we gonna see what other people said about ours?
Yeah, so the grades aren't released because I'm not, yeah, so it's gonna take me some time to do this, right? So I have to read your case, I have to look at somebody's analysis of your case. Two people have analyzed your case, and so that's gonna take a little bit of time. But yes, in the end, you will see what somebody, because that's the whole idea, right? You get to see their feedback as if you were working in a team. You know, somebody would be critiquing your work.
I have two questions.
Yeah.
Did you have like a different assignment for some people?
What do you mean?
Because the case that I got wasn't just a case, it was more like a reflection. Like it was talking about like what you learned in accounting.
Oh, well then, no. So, yeah, no. So then you are gonna have a hard, yeah, so that grading is, I mean, I specifically gave everybody 5 questions to answer with very strict instructions about length and everything. Yeah, so,
I just tried my best to work with it.
yeah, so if you're reading that kind of presentation, see if maybe they didn't like write it 1, 2, 3, 4, 5, maybe they sort of tried to
No, it
answer.
literally had nothing to do with the case.
Okay,
Just you.
well then, yeah, all right, so then there's no credit.
And then for one of them, I wrote feedback, but I forgot to put like a number grade.
Okay,
Is that okay?
well, so you're gonna have to, so is it in the, what you wrote somewhere?
No.
All right, so you're gonna have to email me. I need your final. Yeah,
Oh, you want how we calculate it? So I just put the score in the score box and I just wrote the paragraph of feedback.
well, so did you say I took off for this or this?
No, I just wrote like so many notes.
Okay, so so the feedback, think about how useful feedback is. If you've just kind of given it all and then given a score, right? So if I gave you a grade, right, and I just gave you a bunch of feedback, you'd be saying, well, what'd you take off for this or what'd you take off for that?
Yeah.
So think about how somebody would be grading your papers.
Okay. I think when we read.
It's fine, it's fine. Just for,
Only really because I know what I did. To take off.
yeah, so fine, you can email me, that's fine.
I'll
Yeah,
fix that right now.
Okay.
But I feel bad. It was in my head.
yeah, no, that's fine. Just think about how somebody would be, right, how would you like somebody to grade your paper? You'd want
Yeah, I
that.
thought we had to do the box. I'm so sorry.
Yeah, no, it's fine. Hey, Justin.
Hey, Professor. So you probably got my very annoying on a Sunday night email that I messed up with the submission. Yeah, sorry about that. I was basically on Questrom tools, and then I guess I hit the submit button and it automatically went to the next one. So I thought it hadn't submitted. I was like, oh, I might as well just add some more feedback anyway. So then I basically had copied what I wrote so it didn't lose, and then I pasted into the next one, which I didn't know was the second, added more and submitted for that one and didn't even get to read it. So I don't, I obviously I'd want to give feedback for the other student,
Yeah, okay, so, yeah, it's so funny, I woke up this morning and I had like 50, oh, I did this, or I, like she was just saying, I gave this whole feedback and I forgot to put the numbers in. I had 50 of those emails this morning. So, you know what, it's the first time we're doing it. I'm not too worried. If you want, as I think I said, email me you couldn't do the second one, right?
Yeah.
I'm not too worried about it. If you did one and I know that you did an honest attempt, what you thought was the second one, it's more, so I mean, that's kind of a silly mistake and people did that. It'd be more like for the second one, if you did it again, that would be a problem, but I'm not.
Okay.
About it.
All right. Sounds good, Professor. Appreciate it. Thank you for the understanding. Yeah. Take care.
Bye. Jessica, do you have a question?